Chidu Narayanan joining in at the show right now. Chidu, hi, good morning. And, Taco seems to be playing out perfectly, at least with China this time. Quite a bit of reprieve, you think? Or do you still think that, there will eventually be tariffs on China?
Good morning, and thanks for having me on again. The 90-day push back on China tariffs, well, that wasn't really unexpected. That was pretty much on everybody's horizon, especially after comments from the U.S. administration over the last fortnight. That still means that tariffs on China are an average of over 50% at this point in time, 51.1% effective tariff rate imposed on imports from China into the US. One thing we've had fairly high certainty since the end of last year is that tariffs will certainly be here to stay. The levels might be determined depending on individual negotiations on the situation, but tariffs are certainly here to stay. I would think that the bias near term on China is that they do have a 20% fentanyl tariff that has been imposed, which could possibly be negotiated down to a smaller number very near term. Medium term, I would still expect that tariffs on China are fairly substantial. One thing that is important, though, is that tariffs on China have always been on. Even prior to this particular term of President Trump, we did have tariffs on China. Even prior to Liberation Day, we did have tariffs on China. What has changed over the last 5 months since Liberation Day on 2nd of April is that tariffs on everybody else has increased. So while tariffs on China are 50%, tariffs on most parts of Asia range between 15 and 20%. We have 50% tariffs on India. We have 15% tariffs on Europe. And we also have the specter of tariffs on pharmaceutical imports, auto imports, and semiconductor imports, which might be imposed at a later date. So all in all, possibly China has gotten a better deal than what was expected at the beginning of the year.
Okay, so that's the take coming in. Chidu, hi, morning. Before we connected with you, my colleague Ashesha was highlighting some important global commentary that we've heard overnight. On one hand, you have the fund manager survey wherein you have more fund managers this time around that are getting bullish on emerging market equities. On the other hand, UBS has gone ahead and raised their target for S&P 500 for the end of the year. Where do you think the next round of global equity rally could come from? Could it be from emerging markets or could it be from the US, given everything that's at play here?
So that's an important question, especially for fund flows globally. What we have seen over the last 10 years is that the S&P has been on a tear. We've seen S&P comfortably outperform any emerging market index, any developed market index as well. So investors are fairly heavily overweight on US equities. We do expect over time that this significant overweight will be reduced a little bit more. It will still remain fairly overweight, but we do expect that the degree of overweights on US assets, both equities and bonds, will be reduced over time, which will then weigh on the US dollar as well. Very near term, our equity analysts expect S&P to be even higher to the end of the year, possibly another 10% higher from here, maybe even 15. But the medium term trend is that the exposure to US assets are reducing, still overweight, but reducing. One factor we have seen over the last month or so, especially with respect to India, is that foreign investors have had significant outflows from India rather than inflows, which stands in contrast to most other Northeast Asian, particularly Northeast Asian economies, which have seen significant inflows. Partly, a lot of that is driven by the deteriorating sentiment on India, expectation that the trade deals might have been better, but the end result being that India has a slightly higher, substantially higher, I should say, trade tariffs versus peers in Asia, which hurts sentiment.
Well, indeed, a 30% tariff on China for now, while India, the likely number is expected at 50%. But Chidu, do you believe that the taco trade will pan out for India as well? Is that a possibility? Because for now, the markets are taking cognizant of the fact that $15, the much awaited meeting between Russia and US, something positive might come out, and that could be taken well for the Indian markets. But what is that the investors are working with? What sort of a sentiment are you picking up? Because from 50%, are they hoping for a big negotiation in that number? And any number that you wish to highlight which can be taken positively by the markets?
Right. So there are a few things to unpack here. One, the 50% was initially 25% with a 25% secondary tariff add-on top of that. And second, it doesn't hit all products. It does carve out the pharmaceutical and semiconductor exports that India has, the former more important than the latter. So these are the two specific aspects we do need to be looking out for. Most importantly, it's not the actual economic impact on India, the impact on the current account deficit that is worrying investors. It's the direction of travel and the sentiment hit as a result of that. Part reason why investors have pulled out investments from Indian equities over the last month or so. The direction of travel very near term possibly could be some relief if there is a good news post the Trump-Putin discussions and meetings that are scheduled for the week. Slightly medium term, though, we have had also the specter of pharmaceutical tariffs potentially being imposed. President Trump has talked about 250% tariffs on pharmaceutical imports into the US. Given that that is a crucially important sector for India, and unfortunately the degrees of freedom with the administration in India is far lower than what it might have been for peers, that means that it's more of a price taker, and that could weigh on sentiment a little bit more medium term. So near term risk is to the upside, bit more medium term risks more to the downside.
Interesting. Chidu, I'm just curious, what is it that you monitor other than, of course, the tariff announcement? Is it dollar, which seems to be the indicator of which way money flow is going to move in the world?
The sentiment on dollar certainly is important. We have had risk premia on the dollar increase, which means the attractiveness of the dollar has reduced. So say maybe 4 or 5 years back, if there was a risk event in the world, you would hold on to dollar assets as a risk haven, which then meant that the bid for dollar was higher, the dollar was more expensive. That doesn't seem to be the case quite so much these days. The dollar risk premia has increased with the degree of policy uncertainty in the US, which means the attractiveness of US assets as a risk haven has reduced. That is one factor that clearly drives what happens in the FX market. But in terms of flows, we do have several other indicators in terms of asset allocation, actual inflows into the countries, positioning of investors on FX, flows on the bond market as well. So several other indicators which do hint towards mixed sentiment on investors, some pockets of risk appetite, but a lot of degree of uncertainty.
It's so great to have you on the show. Thank you so much for your time.
Thank you so much. Pleasure.
Okay, a lot of interesting insight on which way the global market